everyone. I'm David Armstrong. Welcome to this wealthmanagement.com Fast Chat. Today, we're speaking with Ian Sexsmith, who's the portfolio manager and senior research analyst at Parnassus Investments. Ian, thanks for joining us.
Thank you, David. Very nice to speak with you this morning.
So, Ian, we wanted to speak to you a little bit about technology companies and innovation and where innovation can be found in the market. We know that in the past year, a small handful of companies, we call them Magnificent Seven maybe, have really driven the overall market higher. Addressable markets, exciting new technology, exciting innovations. But what are investors maybe missing? Why should investors look for innovation in the mid-cap space?
Yeah, well, thank you for the question, David. So let's dive in. These Magnificent Seven stocks, as they're called, certainly have driven the market higher. And these, mega cap tech-enabled stocks have generated really the vast majority of the market's gains this year, which is pretty incredible. Rarely have we ever seen this type of market concentration. So large cap stocks, by definition, have to play in large markets. And at some point, they have to run into competition. And in order for the stock to work, they have to win that competition. In mid-cap, growth land, however, we can stay away from these intensely competitive markets. We don't have to invest in any company that is going head-to-head with Microsoft. So our holdings are the best in the world at what they do, and they're sticking to what they do best. They don't need to expand into new markets to justify their trillion-dollar market cap valuations. Now, that means they can often be acquisition candidates for larger companies. And this past year, Cisco offered shareholders a 30% premium to buy our largest holding at the time, data management platform Splunk. So, thank you very much, Cisco. We'll take it. So in mid-cap land, we can focus on niche markets that are more defensible. So these markets are often highly specialized and they need customized or purpose-built solutions. This allows best-in-class companies to partner with their customers in long-term partnerships to really drive innovation and lower complexity. And that lets companies build products that are deeply ingrained in their customers' business practice. And once someone has built a best-in-class product and they're in a deep partnership with their customers, there really isn't much room for another company to come in and disrupt that. And that allows for some truly exciting innovation. So our biggest holding currently is a company called Guidewire. Guidewire has built a cloud-based software platform for the property and casualty insurance industry. It helps to underwrite policies, it processes bills, it streamlines the claims process. Now, most insurers still use a patchwork of disparate legacy systems that they built themselves. These are outdated, they're difficult to update, they're inefficient to operate. So enter Guidewire, and they are really revolutionizing this industry. So Guidewire is a classic example of a company that has established deep partnerships to build unique industry-specific applications, and that's what you can find in the mid-cap space.
So there's one opportunity. I'm sure there are other opportunities and maybe some risks as well in the mid-cap technology stocks. What are those risks and opportunities maybe that aren't there for the large cap?
Yeah, no, there's certainly there certainly are some differences, and I would say mostly they are exciting differences. Let's start with risks, and a risk would be that mid-cap stocks are less liquid and they can be more volatile than large-cap stocks. So you should keep that in mind when investing in the mid-cap space. Now, let's talk about opportunities. And mid-cap tech stocks really allow you to invest with pure play exposure to a specific industry or a secular theme that can generate durable and resilient growth for many years. So at the start of the interview, you asked about the Magnificent Seven. And I think many large cap investors would tell you that one of the most attractive trends that they want to invest behind is cloud computing. And that's a massive market with huge capital investment requirements, which leads to economies of scale. And that benefits the hyperscalers, Amazon with AWS, Microsoft with Azure, and Alphabet with GCP. So that's true, and those are awesome businesses, but that's not the whole company, and you get a lot of other stuff when you invest in Amazon or the others. As a mid-cap investor, we can invest in Datadog. So if your company wants to use the cloud, then they need to monitor and observe their systems to ensure they're working properly, and Datadog is really the unquestioned leader in the space. So if you want to play growth in the cloud, we would argue that Datadog is a great way that you could do so. Another stock that we own is a company called Trade Desk. Trade Desk is the leading advertising platform for the open internet and for connected television. As a media buyer, you could buy ad space on the walled gardens of Google, Amazon, Facebook, or you could buy ad space everywhere else, and it's Trade Desk that serves that everywhere else. So if you want a pure play on the secular theme of the internet and connected television, taking advertising dollars away from linear television and from print, then Trade Desk is a great way that you can play it. So that's just two examples of innovative pure play companies that you can find in the mid-cap space.
So I imagine the mid-cap technology space is a crowded market, a lot of players there. How do you guys assess competitive advantages there in the companies that you look at when you're screening these firms? Maybe, company moats, maybe, technology changes pretty quickly. What are you looking for like a sustainable, durable investment in that space?
Yeah, that's a great question. Thanks, David. So we would say that a company builds a moat by helping its customers solve complex problems. And if you can do that better than anyone else, then you can protect your moat. So we look for companies that have earned pricing power and create operating leverage by providing a better product or service to their customers. So Guidewire, who I mentioned earlier, they've built an industry-specific software system by partnering with their customers to best understand what features and interfaces they need, and then focusing all of their resources to build that system. It takes a long time to train customers and move their data onto this new system, but after the customers dedicate the time, the results are game-changing. And I don't think Guidewire has ever lost a customer, which is a pretty awesome data point. So one other example of partnering with customers is in the semiconductor industry, where the complexity of leading edge semiconductor chips is just astounding. And semis are really the building blocks of all technology, from electronic and autonomous vehicles to the data centers that power cloud computing to the Internet of Things. And now there's this revolutionary promise of artificial intelligence. None of that happens without semis. And there are only a few companies in the world who have really kept pace in the technological race and are able to create the software and build the manufacturing equipment and testers needed to make these chips. So we own 5 companies here. We have KLA, Lam Research, Teradyne, as well as Cadence and Synopsys. And I'm not exaggerating when I say that almost every semiconductor in the world has been touched by at least one of these companies. And there are, 1 trillion semiconductors that are manufactured each year. So their partnerships are just unbelievably deep as these companies work with their customers on R&D and just amazing new products.
Yeah, we talk about innovation, and I think most investors and advisors, when they think innovation, think technology, the technology sector, and that's true. But can you reflect a little bit about how companies outside of the technology sector innovate?
Yeah. So innovation for us, means making a product or service better consistently. So at our firm, we are big believers in a concept called Kaizen, or continuous improvement. And we expect that from all of our holdings. And disruptive technology is, really exciting, but what happens next? So we don't invest in one product companies or one-hit wonders. And we saw during COVID, some of the biggest winners, companies like Zoom and DocuSign, they had just fantastic success on one product, but as they failed to replicate it, they lost their magic and their stocks came crashing back down to earth. So we look for companies that have a culture of innovation. And the best way that you can do that is, partner with your customers to help them solve complex problems. Now, sometimes that innovation is driven by a new technology. Sometimes that innovation is from consistently providing, best-in-class service with a smile. And when you have a best-in-class product or service, that should mean that you also have higher margins, because the company should have pricing power if you're helping your customers solve complex problems. So that lets the company reinvest back in its people and technology. It's far less expensive to retain workers than constantly hire and train replacements. And then you can also invest in new equipment and technology, which should lower the production costs. Now that really creates, what we would call a flywheel, where winners keep on winning, and happier customers means more revenue, which means better pay for employees and greater investment in new technology. And that leads to better products and better customer service, and that makes those customers even happier. So one of our largest holdings is a company called Cintas. You've probably seen their trucks out on the road. Their core business is cleaning uniforms. So they'll show up at your restaurant or factory, they'll pick up the dirty uniforms and dirty floor mats, they'll bring them back to their facility for cleaning, they'll drop off clean ones. So it, may not be the sexiest business in the world, but Cintas is by far the best in the world at what they do. And their operating margins are twice as high as the next largest player, and their margins are still expanding. So they're further distancing themselves each year from the competition. So they invest in new energy efficient trucks and washing machines, which lowers their energy and water consumption, which improves their environmental profile, and it also lowers their costs. And they're also constantly identifying new products and services that can add more value to their clients. So those are the types of businesses that we love to invest in. These are companies that are the best in the world at what they do, and their corporate culture is built around servicing their clients even better each day.
Well, that's fantastic, Ian. This is great stuff. A lot of opportunity in the mid-cap space. Best to have a partner to help you navigate it, though. Ian Sexsmith, Portfolio Manager, Senior Research Analyst at Parnassus Investments. Thanks a lot for joining us.
Thanks, David.